Makes you think, doesn't it? About how fast things are changing. Nitin Kamath from Zerodha. He pointed out that India's capital markets,
Oh, yeah.
they grew more in the 5 years after the pandemic than in the 15 years before that.
Wow.
Like, that's not just growth, right? That's like a whole different...
That's a whole different ballgame.
Yeah.
Yeah.
So we're going to dive into all that today.
Okay.
Using the Capital Markets Yearbook 2024, which is kind of like our guide
Yeah.
for everything that's happening in Indian finance.
A roadmap.
Yeah, a roadmap.
Yeah.
It covers everything from the stock market and bonds to, like currency exchange, commodities, and even how our investments are being managed.
I mean, it's pretty comprehensive, this yearbook.
It is. It's massive. So we're going to try to pull out
Yeah.
the most important parts.
The key insights.
The key insights.
For our listeners.
Exactly.
So they don't have to wade through the whole thing.
Exactly. So
what I think is really cool about this yearbook is that it doesn't just like throw numbers at you.
Right.
It actually gives you perspectives from people who are, right there in the markets, making things happen.
the people in the thick of it.
Yeah, exactly. So it helps us understand like what's really driving those numbers.
The why. Yeah.
The why, exactly.
Not just the what.
Yeah. So our goal today is to kind of distill those crucial takeaways, so you can really understand the current state of play and, how things have really changed.
Okay. Sounds good.
Yeah.
So let's jump in.
All right.
The yearbook starts by looking at some of the big regulatory developments.
Okay.
And Sandeep Parekh, he kind of sets the stage by saying that 2024 was like a really pivotal year, right? Marked by a lot of regulatory
interventions
alongside all this.
Alongside the crazy tech advancements.
Absolutely. And I think what's really interesting is
SEBI, the Securities and Exchange Board of India, they've been doing this balancing act, trying to keep the market vibrant and growing, but also
making sure it's under control.
Strengthening the oversight, exactly.
Yeah.
And we saw this play out in a few key areas. So, like stricter rules for IPOs, those initial public offerings for SMEs, those small and medium enterprises, which are basically smaller companies that are going public for the first time.
I think there was some concern
Yeah.
about the quality of some of those IPOs.
There were worries about
Like maybe some manipulation
Yeah.
or like
inflated valuations.
inflated valuations. Yeah.
Yeah.
So SEBI stepped in to
They tightened the rules to protect investors.
Yeah.
We also saw changes to like that
Bountifully.
F&O framework,
Right.
futures and options trading.
Which is basically
It's like people betting on where the market's going.
right.
So they tried to curb what they saw as like,
Too much speculation.
yeah, excessive speculation.
Right.
And even like a new thing for companies to delist their shares at a fixed price.
Right.
So all these changes, they sparked a lot of debate.
Yeah, I remember that there were definitely questions about
Yeah.
whether making the rules too strict would actually make it harder for companies to raise money.
Yeah, to get that capital.
Yeah. Or for investors to trade easily.
Absolutely. And it's a valid point, right?
Yeah.
Because any change you make is
Yeah.
going to have some knock-on effect.
Probably.
And the yearbook talks about these discussions, about how these changes might impact market liquidity.
Right. How easy it is to buy and sell.
Exactly.
Yeah.
And overall participation in the market.
Okay.
But, it also highlights that SEBI's trying to broaden investment opportunities, while also putting in those safeguards. Right. So, for example, think about these new investment product categories, like specialized investment funds.
Yeah.
Those might focus on specific sectors.
Right.
Or alternative assets.
Okay.
Mutual fund light, which is like
A simplified version.
a simpler version of mutual funds. Yeah.
Right.
And then small and medium REITs.
Right. So those are
Real estate investment trusts.
Right.
Which allows smaller investors to get involved in real estate.
Yeah, okay.
So it's all about making those markets
More accessible.
More accessible, yeah.
But with a framework.
Exactly. Got to manage those risks.
Yeah.
Got to have that regulatory framework in place.
Yeah, so this is where it gets really interesting for me.
Oh, okay. What part?
The discussion about
Oh.
regulating retail algorithmic trading.
Interesting, yeah.
It seems like SEBI's recognizing
Yeah.
that more and more individual investors
Mhm.
are using technology to trade. Right, algorithmic trading is essentially
Using computer programs to
Yeah.
execute trades based on
Preset instructions.
Yeah, preset instructions, exactly. Right. So it's like, you program the computer to buy or sell.
Based on certain conditions.
Based on certain conditions. Yeah. So it takes the human emotion.
Right, out of it.
Out of it, yeah.
So it's this question of how do you harness that efficiency that algo trading can bring? And also, make sure it's fair.
A level playing field.
Yeah. And protect the average investor.
Right, it's a tough one.
It's a tough balance, right.
Yeah.
And they're grappling with it everywhere.
Yeah, regulators all over the world are trying to figure this out.
Yeah. It's like this whole new...
It's a new frontier.
Frontier, yeah. And of course, sticking with tech.
Yeah.
The yearbook talks about AI.
Artificial intelligence.
Yeah. And machine learning and how they're impacting financial markets. It's a classic double-edged sword, right?
Yeah, tell me about it.
On the one hand, AI can make things so much more efficient.
Right. Especially for...
like identifying risks.
Yeah.
And managing huge amounts of data.
Absolutely. It's like having...
a superpowered analyst.
Yeah. Right. All right.
But then you've got these concerns about transparency. Like, how do these AI systems actually make your decisions?
Right. There's a black box.
Yeah, exactly. And then there's cybersecurity threats.
Always.
And the potential for bias, right?
Yeah, because if the algorithms themselves are biased, then the decisions they make
will be biased.
Yeah, will also be biased.
And what's really interesting is how this all ties into data protection.
Yeah.
Because we had the Digital Personal Data Protection Act implemented in 2023.
Yeah.
And that adds a whole other layer of complexity.
It does.
Doesn't it?
Yeah.
Financial institutions have to be even more careful about how they're collecting data, processing it, storing it.
Especially with all this AI in the mix.
Yeah, exactly. So it's not all sunshine and roses, right?
Not quite, yeah.
The yearbook points out some ongoing challenges.
Right.
Like inconsistencies in the regulations and areas where enforcement could be stronger. And, of course, the constant need to improve investor protection.
Absolutely.
They even mentioned the Sahara refund case.
Oh, yeah.
That's a case that I think a lot of people are familiar with.
Yeah, a lot of people remember that one.
It really highlights those difficulties that investors face when they're trying to get compensation.
Right. And sometimes it takes so long.
So long.
Yeah.
It really emphasizes the need for
more effective mechanisms for investor redressal.
So looking ahead to 2025.
Okay.
What are some of the key things that Parag highlights?
Well, he talks about a more flexible and inclusive approach to regulation.
Okay, that makes sense.
Yeah, so one of the big things he emphasizes is that SEBI needs a clearer strategy for enforcing regulations.
Right, so it's not just about making the rules.
Yeah.
It's about
how you enforce them.
Yeah, how you enforce them consistently.
Yeah, consistently and transparently.
Right.
So he contrasts India with countries like the U.S. and the U.K., where they have a more formal framework for how those regulatory decisions are made.
Right, and how they're challenged.
Exactly, and the concern is that without that, SEBI's actions can be
questioned
and even overturned.
Right, like by SAT?
Yeah, by the Securities Appellate Tribunal.
Yeah.
That doesn't really inspire confidence, does it?
No, it doesn't.
In the regulatory process.
Yeah, so Parag even gives this specific example about SEBI's actions against investment advisors who were using payment gateways.
Right.
And he suggests that maybe issuing an advisory first would have been a better approach.
A more effective initial step.
Yeah, because it gives firms a chance to comply.
Exactly. It's about
encouraging compliance.
Fostering compliance.
Yeah, instead of just jumping to penalties.
Yeah, punishment is the first resort.
Right, and it's also about reducing ambiguity.
Yes, absolutely.
Right, because the yearbook points out that a lot of people in the financial industry struggle with unclear definitions.
Yeah.
Like, what exactly is an advertisement?
Right.
Or an outsourcing arrangement?
Yeah.
And these are things that they need to know.
They need to know.
To comply with the rules.
To comply, yeah.
So giving them clearer definitions would just make everything smoother.
It would streamline the whole process.
Yeah.
Yeah.
And then that whole AI theme comes up again.
It does. It weaves its way through everything.
When we're talking about the future?
Yeah.
With a big emphasis on transparency in those AI systems. And more robust cybersecurity regulations.
Because, let's face it, the stakes are higher than ever.
Yeah, and the fact that some AI decisions are hard to understand.
The black box problem.
Yeah, that needs to be addressed.
It does. If we want people to trust AI, we need to be able to understand how it's making those decisions.
Exactly.
Right.
And then there's this interesting discussion about potentially giving more power to SROs.
Self-regulatory organizations.
Yeah, those are essentially like industry bodies.
Yeah.
That oversee their own members.
Right.
Right. But they operate under SEBI.
Under SEBI's watch.
Yeah, so the idea is that these organizations, being closer to the action, could create regulations that are more agile.
Yeah, more responsive.
Yeah, and effective.
To the actual needs of the market.
Yeah, but obviously there needs to be
oversight
to
prevent those conflicts of interest.
Yeah, because you don't want the fox guarding the hen house.
Exactly.
Right.
Yeah.
So it's about finding that balance.
It's always about balance, isn't it?
Yeah, and this all ties into that bigger idea of harnessing expertise within the industry to help shape the regulations.
Right. So it's not just top-down.
Yeah.
It's a collaboration.
Yeah.
Yeah.
And managing conflicts of interest.
That's always crucial in finance.
Yeah, always.
Always.
The yearbook mentions the ban on volume-based discounts on transaction fees and a clearer definition of
banking activities.
Yeah, which is basically helping companies raise money.
Right, yeah.
So these are positive steps.
They are.
But the message is that vigilance is key.
Absolutely.
You need transparency to keep the market fair.
Continuous vigilance, yeah.
Yeah.
And on the investor protection front, it's not just about enforcement, right?
Right.
They're also calling for a centralized investor compensation fund.
Okay.
And better ways to resolve disputes.
Right. So if something goes wrong, investors have somewhere to turn.
Yeah, and a clear process to follow.
Right.
To get their grievances addressed.
Yeah, because that builds trust, right?
Absolutely.
That people feel like the system is there to protect them.
Yeah, that there are safeguards in place if things go wrong.
But interestingly, the yearbook also warns about the potential for overregulation.
Too much of a good thing.
Right. So they talk about things like those prohibitions on regulated entities, working with unregulated ones, and the broader definition of insiders.
Those with access to non-public information.
Right. And these things have raised concerns about
compliance burden.
Yeah, increasing the compliance burden.
Potentially stifling innovation.
Right. Because if it's too difficult or too costly for new players to enter the market.
Right. Then
you're limiting
competition.
Yeah, potentially innovation.
Yeah.
So it's that classic question of where do you draw the line?
Finding that sweet spot.
Right, where you're protecting investors.
Yeah.
But you're not stifling the market.
Yeah, not making it impossible for businesses to operate.
And so the yearbook suggests conducting cost-benefit analyses and regulatory impact assessment.
Before you roll out those new rules?
Yeah, which seems like a pretty sensible approach.
It does, doesn't it? Yeah.
It's about being thoughtful.
Yeah.
And not just rushing into things.
Not just knee-jerk reactions.
Yeah, exactly.
Yeah.
So as Parrott concludes, the goal is to create a financial ecosystem that's
not just big,
but resilient, inclusive.
Absolutely world-class.
That's the aspiration.
Yeah. Now let's switch gears a little bit.
Yeah.
The yearbook dives into this whole world of finfluencers.
Oh, the finfluencers?
Right. And Shruti Rajan gives us a really comprehensive overview.
Okay.
This is a phenomenon that has just exploded, hasn't it?
It really has. It's like everyone's talking about it.
Everyone's got an opinion on it.
Yeah. So the yearbook starts by defining who these finfluencers are.
Okay.
And they use definitions from
IOSCO.
Yeah, IOSCO and SEBI.
Our own regulator.
So essentially, finfluencers are individuals who use social media to talk about investing and to influence people's financial decisions.
Yeah, so we're talking about YouTube, Instagram, Facebook, TikTok,
even X,
Telegram, the whole gamut.
The whole gamut, and each platform has its own way of
reaching people.
Yeah, reaching different audiences.
Yeah.
So you might have like in-depth analysis on YouTube, and then quick tips on TikTok.
Bite-sized content.
Yeah, bite-sized content.
Yeah.
And the reach of these platforms
is huge.
Is massive.
Massive.
So it's no wonder that finfluencers have become so influential.
Right, but the question is that influence always a good thing?
Right, because the yearbook also talks about the concerns that regulators have.
Oh, yeah.
SEBI in particular. So one of the big worries is misinformation.
Yeah.
Right, because a lot of these finfluencers, they don't have formal qualifications.
Yeah.
They're not registered advisors. So there's a risk that they could be giving out
bad advice.
Yeah, bad or misleading advice.
Yeah.
And that could spread really quickly.
Like wildfire.
Yeah. on these platforms.
Exactly.
And then there are conflicts of interest.
Yeah, because they might be
promoting certain products.
Yeah.
For their own financial gain.
Right. So they get a commission.
Yeah.
Or some kind of kickback.
And they might not disclose that.
They might not be transparent about it.
Right. So it's not clear to their followers.
Yeah. That their advice might be biased.
And then there's market manipulation.
Yeah. Things like pump and bump schemes.
Right, where they artificially inflate the price of a stock.
Yeah, and then they dump their shares.
And leave their followers holding the bag.
Yeah, holding the losses.
So it's a real concern.
It is. It's a legitimate concern because a lot of these finfluencers, they don't have that same level of scrutiny.
Yeah.
That registered advisors do.
They're not subject to the same regulations.
So there's a higher risk of investors getting bad advice.
Absolutely.
And so the yearbook lays out some key things for investors to keep in mind when they're engaging with finfluencers.
Like do's and don'ts.
Yeah, do's and don'ts, which are really important.
They are. So first of all, verify their credentials.
Right, if they're claiming to be
a registered advisor.
Yeah, check if that's actually true.
Check their registration status.
Yeah.
Be skeptical of those promises of really high returns.
Right. If it sounds too good to be true.
It probably is.
Yeah, it probably is.
Yeah.
And understand that they might have
their own financial incentives for recommending certain things.
So look for those disclosures. Yes, transparency is key.
Yeah.
And do your own research.
Always, right? Don't just blindly follow.
Don't take anyone's word for it.
Yeah.
Do your own due diligence.
And never, ever share
sensitive information.
Yeah, personal or financial information.
With anyone who's not regulated.
Right, so that's really important.
Yeah, protect yourself.
So what have regulators actually done to address these concerns?
The Advertising Standards Council of India.
OSI.
Yeah, OSI, they've issued guidelines that focus on transparency and disclosure.
And financial advertising.
Yeah, so they want to make sure that when finfluencers are promoting something, they're upfront about it.
Right.
They're disclosing any financial relationships.
Yeah, okay.
So SEBI's approach has been a little bit more indirect, but quite significant.
Right.
They've essentially banned regulated entities.
Like brokers?
Yeah, brokers and investment advisors.
Yeah, from working with unregistered finfluencers.
Exactly. So if you're a registered entity, you can't just partner with any finfluencer.
Right.
You have to make sure that they're also registered.
Okay, so they're trying to cut off that financial link.
Exactly.
That might incentivize bad advice.
Yeah, that might lead to those biased recommendations.
Okay, so there are exceptions though, right?
There are exceptions for educational content.
Okay.
So if the content is genuinely educational.
Right, meaning it's not
giving specific stock tips.
Yeah, or advice.
Or trying to,
pump up a particular stock.
Yeah, manipulate the market.
Right.
Then it's generally exempt.
Okay.
And then there's this concept of specified digital platforms or SDPs.
Okay.
So these are platforms that have their own oversight mechanisms to prevent problematic finfluencer activity.
Right. So it's like they're policing themselves.
To some extent, yeah.
Okay.
Now, registration as an SDP, it's not mandatory, but it does offer...
Like a safe harbor.
Yeah, kind of safe harbor.
For regulated entities.
Right.
Who want to work with finfluencers.
Yeah, so if you're a registered entity and you're working with a finfluencer on a registered SDP... you're less likely to run into trouble.
Okay, so it's like SEBI is saying, we're not going to ban finfluencers outright.
Yeah.
But we're going to make it risky for regulated firms to work with unregistered ones.
Yeah, unless they're operating within this framework.
Right, so it's like a carrot and stick approach.
It is. It's about incentivizing the legitimate players to get registered.
And it also helps SEBI, right?
It is, yeah.
Because it gives them more oversight.
Yeah.
They can monitor what's happening. They can enforce the rules.
And address investor grievances.
Yeah, and even impose penalties.
If necessary.
If necessary.
Yeah.
But the yearbook also acknowledges that there's this debate
about how far the regulation should go.
Right. Where do you draw the line?
Yeah. So some people are worried that the definition of investment advice is too broad. And it might even capture people who are just trying to educate without giving specific recommendations.
Right, because not all financial information is investment advice.
Yeah, and then there's the cost of compliance, which can be a barrier.
Especially for smaller players.
Right, so it's about finding that balance.
Always that balance.
Yeah, between protecting investors and encouraging innovation.
Not stifling creativity.
Yeah, and the yearbook looks at
Yeah.
how other countries are handling this.
Like global best practices.
Yeah, so they look at the US, the UK, Canada, Hong Kong.
Okay.
And some of the key takeaways are proactive monitoring and robust enforcement.
So you're not just waiting for problems to arise.
Right, you're actively looking for them.
You're out there monitoring the landscape.
Yeah. They also talk about collaboration with social media platforms.
Okay.
So like in the UK, the FCA, the Financial Conduct Authority, works with the ASA, which is the advertising standards body.
Right.
So they're working together to make sure that financial promotions
fair and accurate.
are compliant with the rules.
And then there are investor education initiatives.
Yeah, like in Canada, they have this campaign called Human Disclaimers, which emphasizes critical thinking.
Right. Don't just believe everything you see online.
Exactly.
And in Hong Kong, use online games and quizzes.
To make financial literacy more engaging.
Yeah, make it fun.
Yeah, exactly.
So it seems like a multi-pronged approach is needed.
Yeah.
You need monitoring, you need guidelines, you need education.
And holistic approach.
Yeah. And the yearbook concludes that finfluencers are a revolutionary force.
They are.
But finding that balance between
benefits and regulation
is crucial.
To keep the market fair.
And protect investors.
Absolutely.
And they say that over-regulation
could be counterproductive.
Yeah, it could stifle the good along with the bad.
Right.
So a collaborative approach involving everyone.
Regulators, industry, investors.
Yeah, is essential.
To find that sweet spot.
And SEBI needs to be adaptable.
Yeah.
Using things like
regulatory sandboxes.
Yeah, to test new approaches.